All right, guys, what's happening? Live financial modeling stream. Here we go. I'm Jason from SmartHelping.com. It's 10 a.m. on a Tuesday. And so, yesterday in the model, we did a whole bunch of imports, got a bunch of formatting done. Today, we're going to try to build accounting references to the three statement model and get all that sorted to this manufacturing plant startup model, 10-year model. Before I get started, don't forget to subscribe to the channel. Hit the bell if you want notifications when I go live or do new videos. And most importantly, check out smarthelping.com if you want to see more. The model I'm actually doing right now is part of the industry specific bundle that I'm upgrading. It's right here, manufacturing plant. And uh, check out the site. There's all kinds of stuff here. If you do Excel or Google Sheets, use those in any of your businesses, you can find some value here. There's stuff for HR departments, accounting, a lot of SaaS, joint venture cash flow waterfalls. You can check out all the models here. You can buy in bulk. You can get all the templates on the site for $9.99 or get certain levels. They're all labeled here and color coded. Lots of stuff here, lots of value. I've been working on this for, this is going on 7 years now, and I just love it. So right now we are in the middle of the giant upgrade of adding financial statements and cap table and just upgrading all of the startup models. This is, I think I'm on number 13, and it's a challenge. It's tough, but I believe in it. I think the value here is great in long term, so we're doing it. Let me put in the YouTube link real quick to the Twitter. To the Twitter. Uh, okay. All right. So let's get started. There's a lot going on here. Day one kind of explained the model. I tried to get all the stuff in, unbroke everything I could, but um, that was more of an explanatory thing of how everything's working. Now we're going to try to implement. So there's going to be a lot here. We're going to try and do the income statement first. This is one of the only financial models where you'll see non-cash items in the cost of goods sold, which would be um, or which will be depreciation, because the depreciation is a direct expense of producing units. So we've got all that logic mapped into the monthly detail tab here. We got direct labor, payroll taxes, direct material costs, indirect, and then depreciation, which is driven off the depreciation matrix, which runs off of this schedule. And this schedule I hooked into the CapEx schedule here, which we'll use with our current model or imported three statement model. And this is probably going to be the most difficult part, I imagine, to get this all to balance. And that's really what a three statement model is it's an ultimate sanity checker. Clear validation here. It's an ultimate sanity checker to make sure your numbers all make sense in accounting terms and you're not double counting anything. So let's see, let's go to revenue first. So revenue items we've got would be items sold. I believe that's it, just whatever you're producing. There's up to 10 types, but we're just going to do one line item for that. So we go into income statement. This will be I'll just call it unit sales. And that's going to be directly equal to this number here. And we could just drag us over. Now this is a 10-year model, but keep in mind you can run it, put the end month to any month, so it could be 5 years, 3 years, any amount of months up to 10 years. All right, so there's revenue. Which is driven off of basically this logic as well as the start month of each unit when it starts to be produced. Cost of goods sold. So I think we might need a couple items here. Let's start with depreciation. So depreciation that's assigned to direct production is going to be here. Oh, no, sorry, down here. Okay. Now, I don't think I have any other, let's see, fixed expenses. So it's production overhead, G&A, R&D, sales marketing. No, so that's the only cost of goods sold. Wait. Hold on. We also have, so that's depreciation. We also have just um, cost of materials. So where's that at? Let's see. Oh, cost of goods sold. We have a whole bunch of stuff. So depreciation assigned to the plant and building. That's also going to be assigned per unit. Indirect overhead, materials, okay, and direct labor. So lots of cost of goods sold here. Man, this is going to be an awesome model. It's going to be a hard one though. So depreciation, materials. So let's assume that this building is the actual plant that things are being produced in. So we're assuming that's a cost of production, cost of goods sold. We'll separate it out here. Plant. Also, what else? So we got that. We did this. We did raw materials. We need direct labor and indirect overhead. All right, let's link this in. So materials is that. Depreciation of the plant facility. This. Direct labor. Indirect overhead. So I should result in the same gross profit as I have on the monthly detail. So we will see about that. We want to sum up to 18. All right. So gross profit. Let's see. What do we got? 147,082. 147,082. Okay, so we match up to here. That's good. Very good. Now we have other operating costs. So these are outside of directly related to what you're selling. So we've got like a general administrative costs, research and development, sales and marketing, also payroll taxes outside direct labor, and units waste. So those three payroll tax benefits. All right, so let's put that in there. So we've got um, general and administrative, research and development, sales and marketing. Then we have payroll, taxes and benefits separated. And then finally, waste. All right, let's link it in there. So G&A, R&D, sales and marketing, payroll tax benefit, outside direct labor, waste, and then we're going to have startup costs. Okay, what's next? Let's see. So EBITDA is just gross profit less OPEX. So let's make sure that matches. So 127, 711. Oh, we are out. 131, or by about 4 million. Because EBITDA, we need to add back. So this was very confusing. I remember this. We needed to add back depreciation because earnings before interest, tax, depreciation, and then net income will then flow. These will flow back in. All right, so right. That's why we have EBITDA. Then we did EBIT, all this other stuff. So let's see. So EBITDA is this plus depreciation here and here. So this is kind of, the EBIT is trying to show what the business is generating in cash flow. All right, 136.51. 131. What are we missing? Let's see, 156. So gross profit plus these two depreciation items. Yeah, 100, 114. Yep, E56 plus those minus total expenses 284. And total expenses would be these three. And that's it. So that should match what we have. So 709, 756. Oh wait, startup cost. Okay, hold on. So in this, we're assuming these are all tax deductible. So sum that up. Okay, so this is fine for this. I just need to make sure that's the only difference. So let's do a check here. So EBITDA on here, income statement, EBITDA on here. And the difference of that, 540, okay, which is a startup cost. So that's fine. Sales. So we're good up to EBITDA. Now we have interest, which is fine. Now we have depreciation here. So this is the tricky part. This is the tricky part. So it has buildings and then items through 77. Let's see, is that all of them? B80, 80, let's see, 80. So here's where we got to try to reconcile all this stuff. So I put depreciation down here because we got to get to taxable income and then net income. Now this is 15,000. All right, and I've got 16 plus this. So 8169, 8169, that matches. However, what about this 16,333? That should match the rest of this. This is only 6,000. So let's see. Oh, I have a count here. I have count. So that means initial cost is actually column G. So if I go to my CapEx, G4 should be this, G4, not E4. And that should do it. All right, let's go back here. So 16,333, and I got 16,333 totaling of 24,000. So let's just do a quick check here. This plus that equals that. True. Now let's make sure these are all true. Looks like it goes for 10 years. Okay. Perfect. So this depreciation matches from a CapEx schedule, which goes back up into equipment, which is what this is derived from on the monthly detail. So now that's great. When I go to taxable income, or net, let's see. So net income is going to then subtract that back out. Taxes. Okay. So that's fine. Next part is going to be inventory, I believe we have to hit. This income statement looks good here. I like where we're at. I like where we're at here. So let's go. Okay, so we got cash flow statement. So operating activities is going to be customer receipts, which is row 10. Yep. Other OpEx. Now this part. So let me go to, what's the last template I did like this with inventory? It was used car dealership. I'm just double checking here. So on this cash flow, I did payments here, not cost of goods sold, because that is in this number. So revenue, OpEx, interest taxes, and then payments out. How it, yeah, that's the actual cash flow then for the month. Operations, interest tax, payments for goods. Okay, let's see here. I'm just thinking. All right, so that's fine. Other OpEx, let's see, what are we doing? 31 and 19. So 19, yes. Well, no. So all we want to pull is, hold on. What did I do on this one? I did only M25. So I didn't take any of this cost of goods sold for inventory. So on here, let's just, so 0, otherwise we want to take other OpEx, we want this and this. We also want all of this. Now direct labor, indirect overhead. Yeah, those are cash flow out items in the period. Okay, so that's all of this. Payments for interest, 37, that should be fine. Yep. And taxes is 126. Yep. Okay. So this is actual cash flow, but we need to add in, we'll add this on the annual too under other OpEx. We have to add in payment for materials. Now I believe I have a schedule here, so I think we just assumed, yeah, this is no longer relevant. Purchase of raw materials, I believe that's when the actual cash goes out. So cash goes out to buy things, and then as you sell it, this will go down based on the cost of goods sold. Okay. And that is driven on our inventory logic, which I believe is here. Raw material purchases. Now, what is this driven off of? This here. Okay. So months ahead raw materials purchased for. So 3. So what that means is you buy here, and then it includes inventory for Jan, Feb, and March. You buy April for April, May, June. So every 3 months you're buying inventory for the 3 months period coming up. All right. Okay, so CapEx F3 to FC80, that looks right. So this is all the equipment and building, all of this, these costs. Terminal value. So terminal value, we've got the building in there. Let's think about this. So probably a manufacturing. We can look it up real fast here. So manufacturing rules of thumb for valuation. Percent of annual sales, last 12 months sales. Yeah, that's what we use. Okay, perfect. That makes great sense. So this is going to be based on trailing 12-month sales and a multiple based on that. Percentage of sales. So usually, it'd be like maybe 80, some percentage there. Yeah, it could be over 100, but probably not. All right, so multiplier of 12-month sales. Then we go into terminal value. So we want to define trailing 12-month sales. That's just going to be, there's logic already in here to determine the last 12 months based on the end month. We just want to sum up instead of 34. We're going to sum up 10. And then there's the multiple. Trailing 12-month sales multiple. And there's the value of that. Percent applied extraordinary income. This is if you want to apply some of those sales to the equipment as well as extraordinary income, which will just affect taxes. If you're not including taxes, it doesn't matter. Just put 100% here. So you give that amount, and then the sales proceeds of the building, and that's the total. That looks fine. So you can see that here. This is all fine. Borrowing, debt, principal, sale of company stock. So here is a big number. So we actually can't figure that out until we get the monthly off matching anything else that we added. So this cash flow needs to match what's on this to get this correct number. And I guess we could do that now because there's nothing else that we should be adding, I don't think. So I want to accumulate the cash All right, obviously this is not right. What's going on here? So, okay, this is where I'm going to add some stuff. And also let's put this in here. Okay. So we're going to try and keep all this in the same row. Exit value is not that. We can just simply reference cash flow statement. Sale of business plus sale depreciable assets will be the total exit value. So you can see if I go down here, this should be that 22 million. 29 million, sorry, for including the building. Annual sales are 27. Okay, good, just checking. All right, so we did exit value, building and sales already here, so we don't need that. We do need, unless I did it somewhere, well, let's just clear this out for now. Oh, I already had fixed asset sales in here. Well, we've already got that in the other calculation, so we don't need that. Equipment and raw materials. So this would be CapEx. And here we'll just do this. That startup costs, investor, this we don't need. Building is already in CapEx. The 6.9. Raw materials. Exit value. All right, so we can delete some of this stuff. This, oh, hold on, never mind, let's undo that. This we don't need. That's going to be an amortization schedule. Yep. Okay. Oh, then we have, let's put taxes in here. And I think that's everything. So, cash flow before equity. So this is tricky. Well, so where do we start in here? Ebitda. Yeah, okay. Ebitda 287 minus debt service. Okay, so this taxes, if we're going to reference that there, that's fine, but let's just put this equal to that. Actually, we don't want this even in here. We're going to just go to earnings before tax here because we're already doing the deeper calculation on the income statement, so this is fine. Earnings before tax. It's a good calc. Let me just redo this calc then. So cash flow before equity, I'm just going to call this cash flow. cash position, cumulative cash flow. The cash position will be on the balance sheet. All right, so Ebitda. Hold on, let's clear this out too. Ebitda minus, all right, startup costs minus debt service plus funds from debt financing plus exit value minus taxes minus capex minus raw materials. Okay, so we already have startup costs here and here. I want this to be in the minus 319. I want this to be down here, so we're going to just remove that 291 row. And we don't need that. This. All right. Now we should be able to drag this over. And we don't need this. That's fine. So 327 is our row for cash flow. 327. So this is saying you need 7,790,000 to survive the burn and startup costs based on all these assumptions. Now the question is, we got to make this look good for the annual. So yeah, this is all messed up. So let's go. First of all, we clean this up. We can delete these tabs. That, this, and all this. All right, so it should go EBIT, and then the next thing is 305. I'm not doing any of this anymore. And then this is 306. Let's just go right down the line here. Besides these two, we want to be actually that. And then here we just reference this. Earnings per unit produced, we'll just make that based on, no, I don't even think we even care about that. All right, so now we just make sure this should equal out to this number. We're out by 4 million. 4.46. So what is that? Let's see. Oh, got a circular reference error. We'll have to figure that out. 446 is that? Ah, this doesn't make sense. Clear this out. 540. That's startup costs, which should be here. Okay, nice. So that matches. Now we got to figure out where our circular reference error is, if there is still one. Probably something to do with the balance sheet. Oh yeah, our balance sheet's out of whack here. So, well, we have cash. We also have inventory, so let's put that in. Value of inventory is going to be equal to negative what you bought. So you buy 1,000,000 of inventory minus your cost of goods sold for inventory, which is this. And then the ongoing amount is that plus this. So it gets to 0, you buy more. Yeah, that makes sense. All right, now this is where things get a little tricky. So we got cash inventory. Whoa, look at that. We balanced. Holy cow. Well, that's a good sign. Oh my goodness. So we got this, we got accumulated depreciation, all our equipment, that cap table money based on all of these inputs here. Retained earnings. Wow, so this is awesome. We are in balance. That's great. That is great. All right, let's put the inventory calc in here. And let me check how I did this. So balance sheet annual. Oh man, so this was not, this was, this was a complicated one. All right, let's copy this over. So we're going if year of C5 equals global control C7. Let's just pause there. Yep, that's the exit year. Then index balance sheet 12. We want, yep, balance sheet 12. If, wait, oh yeah. So it's pulling the last year. If it's the end year, pull that. C6 is the month. Yep. Otherwise, index 12, match E-date C5, balance sheet 5. So is it 0 every time? So year end, it's saying it's 0 every time because we're buying every couple. Let's buy inventory. Let's do 4 months at a time. Well, that's still 0. We'd have to do an odd number, I guess. Oh, wait. Let's try 5. There we go. So now we got, I just wanted to see some numbers in here. So 5, so we buy it, goes down, 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 down. Hit 0, we buy more, use it, down, down, down. Okay. And then, yeah, nice, that's it. So everything else looks good here. So balance sheet, monthly and annual are solid. I can't believe it. That's really good. So, man, this is great. We don't have a whole, so what else? We got distributions, executive summary. The fact that these are all balanced out is awesome. And it all worked with this logic. That's awesome. Awesome. Okay. Well, did we get rid of the circular reference error? Maybe that was something that I did at on the annual there at the end. I removed, well, all I did is actually add this and removed some stuff up here. Yeah, we don't need these here anymore. Okay. And it could be a stuff on her from it. It could be the visuals. Um, let's delete that. This doesn't make sense anymore. The rest of this looks okay. We'll go back to these visuals at the end and see what's going on. But I think that was probably it was the visualizations. We're referencing the error cells. All right, our balance sheet's still good. Yep. Okay. So we'll do all our checks at the end. I still need to do distributions. So here we're just going to sum monthly cash flow in and out, which is 308. It's already there. Perfect. Here, remaining equity to use is just the total equity contributed, which is cap table this amount minus any startup costs there in the first year 0, which is just this. And then that is equal to global control equity required by the project, and same thing here. So 5, and then this should match 46, 314, 46, 134. Might be, let's see, why are these numbers showing weird? Oh, whoops. So investor share, um, investor share is fully diluted ownership value. This, there we go. Okay. So you got internal rate of return of the project. You got internal rate of return for the investor, owner. Oh, let's update these as well. So this is negative that. And then this is negative that. So this is a check, and this is going to be that. All right, moving and grooving here. Investor owner summary, that looks good. Now, obviously, this is assuming that dividends are distributed on available cash flow. Um, if not, then obviously the balance sheet's showing what cash is available and what equity is there, and then the percentages are on the cap table. But to do a proper discounted cash flow analysis, assuming there are distributions, we could do it for the project as a whole and then as each individual equity contributor. If that's what you want to see. Now the question is, and this will be in a check, but I just want to see 46, 134, 46, 314. So what is that out by? 180,000 even. What in the world is that? 180. Hmm. Well, it's odd that this cash flow at some point, this cash here should hit zero because we're only borrowing, or we're putting in exactly enough equity so that the net cash is zero. Which means this should be at zero here. So we might, let's see what's going on. Got a couple things going on here. Oh, so the difference between these two, okay, hold on. So this distribution, I know what this is. So we take out startup costs, but we also include funding against what's available. All right, wait, now it's out by 70. Is there something else here? Funds in, out, 290, and then we're getting in 8529. Oh, because these are two different numbers. So this should be 16 should be the number, not 19. 16, 16, 16. So 16 and 16. Okay, good. So that matches. This is check against annual detail. Okay. Now to this other mystery. Why are we not arriving at a zero here at any point? We should be. If you go to the monthly, if we assumed we did have the starting balance of equity here, then our cash flow is 290 plus this. And then we go here plus this. Oh, so it's the first month. So that must mean because we're including startup costs in month one and not zero, there's enough cash there. So uh, if we just delay, let's say we delay one of these units to not start till like March or a couple of them. March. I'll say March, not here or here. Okay, that didn't have enough of an effect. Still zero on the first month. Let's try. So the building purchase is let's lower this amount to say 1 million. Still, I'm trying to make the basically the OpEx higher earlier. Let's add a couple more expenses. And this is just for my logic. This is not really like all the assumptions in here are arbitrary. Like when you fill this out to use it, you put in all this information that's relevant to your situation. All right, this actually doesn't change. Let's put this back to January. So we're making money right off the bat is what this is. And I'm trying to make it so we don't. Let's lower sales. That's a good way. This is just a logic test here. Well, actually, what if we do this? What if we spread that out? Okay. Now we hit zero here. So now if I go to my balance sheet, we should be hitting zero. We still don't. It could be something. It could be something with all the stuff going on with depreciation. Usually, I'll always see a cash balance here hit zero because it should based on this. Like if we get initial influx and then this is operations, we go to zero and go back up here. So April 2022. Wondering if I'm offset somewhere, but it is still balancing somehow. Like I could have the same numbers, but am I not, you know, D, C. Are my raw materials the same? So let's say 239 and 1,042. Yeah, that's the same. 1821. So this number should equal, so my net change in cash if I start in February. It's a little bit different. Well, so that could be something. Let's see, what is this difference? Taxes? No. $496, 96, 25, 25, 25, 25, 25, 25. So it's something with a pattern. I just see why these are different. So 156, 156, 174, 195. So what could be the difference? In February, I have 177, and then I have 1206 here. So there's nothing happening in these items. There's debt service. It should be principal 330, and then interest 936. Yep, got that. Did we add waste and all that? Wait, I guess one way to check is, let's see, what's the ending cash balance here for the annual detail? Whoa, wait, that's way off. Okay, we definitely have some trickery going on here, so we got to figure this out. I mean, ending balance of 102 million. 76,842,000. There's got to be. Got to be something. Let's make sure. So cash flow here, do we include waste? We did 17, 18, and 31. 17, 18, and 31. So yes, 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 and the waste is in here. So that's all included. This is, and that's all in there. So what could be the difference? Let's see, 115,000, 115, other OpEx, 292. So let's see, what do I get for other OpEx here? Should be 292, which is that. Plus material purchase, which isn't here. Okay, so wait, here's something. In the cash flow, I have payment for materials, other OpEx should not include that. So if I'm going to balance, I need to say so other OpEx is for February. It's this number. I've got 292 plus indirect overhead plus payroll taxes, direct labor. So 294. How am I off by 200 or I'm off by 28,000? In this February period, I should be able to match with my cash flow in the monthly detail. Should match this. All right, let's just go one by one. So I'm just going to go each of these. I knew this was going to be a nightmare a little bit. So customer receipts matched February customer receipts revenue here match. Other operating expenses should be direct labor, payroll taxes. Ooh, direct raw material, 28,984. Is that what I'm out? Yes. Okay, okay, okay. So direct material, so that's a cost goods sold item. So this does not include that. And I also should not be including this number in my cash flow because that is this. Okay, so what we need to do is, because that's included in Ebitda, in cash flow, we need to add that back. Add that back. And now that will affect the number and it'll change everything. And now we should see. I knew. So you can still balance. You can still balance your balance sheet, but my balance sheet and this are not directly related. So, and they were not congruent because my cash flow here, which is determining how much equity I need, was actually saying too high of a number because I was assuming I have to pay double the material cost, but I should be, because when I go to Ebitda here, let's just make sure this is taking gross profit, which gross profit is reducing all of the cost of goods sold, which does include um, depreciation and direct overhead, raw material cost. So when I go down to Ebitda, I'm adding, I'm doing gross profit minus total expenses, but I'm adding back the depreciation. I'm not adding back the raw materials because that's part of that would be counted as your cost for that period for your raw materials, but cash flow it would need to be added back. Okay, so now we go back Boom, look at that. We have a zero. That's what we want to see. Balance sheet, cash flow, current asset. We get to zero, then we go up from there. Okay, so that's one mystery. The other thing is, what am I missing on this? This is off by 75 million. So, am I missing? I don't even know what's that much. Let's see. Do we have taxes in here? Taxes are 27. Well, let's just go to cash flow. All right. And let's go to the, hold on. We need to update the annual as well, real quick. So this needs to add back material here. Okay, so that's lined up. Now the question is, okay, what's the cash flow annual look like? And let's do this minus that. So those two should match 4208, 4208, perfect. Now for 2022, okay, we're just gonna see what's going on here. Okay, they all match up. Did I do a calculation wrong? Equals this, equals that, plus that. Wait, it's at 96 million. What just happened? Which now I'm only out by the 5,032,000, which is the investor proceeds, which is right. I'm confused. Let me. Oh, there. Okay. So it was double counting the material costs. So if you go look over here, I was counting the purchases below, but I was also counting this up here. And this purchases for 70 million is the same as this for 70 million. So I was counting them as two expenses. That's why you got to sanity check everything. Okay, so now we're good. 96. Okay. Cash flows. If you're doing an audit on accounting, the cash is always the most difficult thing to reconcile. It just always is. It's just always because so many different things hit it. All right, so let's take a break. It's Tuesday. We'll do one more stream tomorrow to finish this up. Tomorrow I'll do the executive summary. We might mess around with some of the visualizations, and then we'll do our global sanity checks, and then this thing will be all wrapped up and ready to go. It overall, I actually feel like this um, this live modeling for the manufacturing plant is going. It went more smooth than I expected. I thought it was going to be way more difficult with all the different things because the inventory, the capex was weird, but we're good. We're good. So I'll finish up, like I said, executive summary, sanity checks, maybe mess with the visualizations, and then we'll be good. Don't forget to subscribe to the channel, like the video. Um, check out smarthelping.com. All these templates I've been working on every day. And I'll see you guys on, well, tomorrow at 10 a.m. And don't forget, after I finish this, um, the manufacturing model, I'm going to be doing a pretty cool template on investment management. Like if you're tracking a bunch of different positions, buying and selling, and you've got a fund with, up to 20 members, I might add more, I don't know. It'll show the distributions over time based on percentages and all different kinds of cool logic. It's got one of the most innovative pieces I've done on tracking if you have multiple buys and sells over time in the same asset, and you're trying to figure out when you sell something, what's the actual profit, which means you need an accurate cost of goods sold per unit. I figured out a way to do that in Excel. It's kind of similar to what I did with the FIFO cost of goods sold model, but it's more strict, I guess you could say. And I think it's really it's one of the only ways. And that's why everyone has such a hard time with it, because you have to match sales with cost if you're doing partial, you know, multiple buys and then sales that are not, you know, fractional of the total you bought at a given point in time. And then you start, if you buy, sell, and then if you go buy again, you can't, that new buy in the same asset is a different cost than your initial buy. So there's a lot of logic there to do. I've cracked it, and I'll show you guys that probably Thursday or Friday. We'll see. I got to finish this, do the overview video for this, and then get into that one. Alrighty, I